All, welcome to the weekly Saturday knowledge sharing webinar from Mehta and Mehta, organized. Today's webinar topic, NBFC Masterclass 3, Prudential and Governance Norms, Non-Banking Financial Companies. And presenter is Aditi Prabhu, and our panelist is myself, Mehta. People knows me, partner, our own Mr. Professor Bala, who is a moderator, Sudha, who is a chief consultant of Mehta and Mehta, and of course, Shan, past deputy vice president, company secretary, compliance, Hinduja, Leyland, Finance Limited. And we have also Ms. Alifya Sapatwala, partner, Mehta and Mehta. To briefly introduce our panelists, Mr. Shyam is past Deputy Vice President, Company Secretary and Compliance at Hinduja Leyland Finance Limited. He is a fellow member of ICSI, also holds master degree in law and also insolvency professional. He also possesses postgraduate diploma, BA degree in finance and management from Indian Institute of Banking, certified in NBFC operations. Apart from this, he is also CIS certified CSR professional. He has over 22 years experience on compliance, legal, secretarial domains in various sectors such as consulting, manufacturing, IT, financial service industry. With our other panelist, myself to introduce, I'm founder partner from Mehta and Mehta, and IP professional and lawyer. We have another panelist, our own Mr. Balakrishnan. He is a moderator. He is a company secretary having almost 4 decades of experience in secretarial compliance. He has worked with Foseco India Limited as a regular speaker at ICICI CCGRT and contributes various articles to various magazines. Our other panelist, Mr. Sudhakar Saraswatula, Chief Consultant Mehta and Mehta. His personality is known to everyone. And he is also member of CA, member of Company Secretary, Secretary Institute of Charter Secretary Administrator UK. And he was a past president of the Corporate Secretary Department of Reliance Industries Limited for 17 years. We have with Alifya Sapatwala, now associate member of ICSI, and she is also a law graduate, and she possesses around 10 years of experience in corporate secretary and legal field, and specialize in LODR, FEMA, NBFC, secretarial, and compliances under various acts. So, friends, welcome to this webinar, and I'll request Mr. Shan to say a few words about the topic, and then Sudhakar and Mr. Bala, and we can start the presentation. Over to Shan. Thank you.
Yeah, good morning to everyone, and thank you, Ms. Aditi, for the introduction. I'm happy to be part of this webinar, and I think this masterclass on NBFC is something which is very, very significant and important for the various professionals who are working in this sector. To start with, if I may give a brief on the NBFC sector per se, as all of us are aware that NBFC sector is has become one of the critical sectors. In addition to the banks, in fact, they are also called quasi banks, where their business in terms of lending to various categories of customers is almost on par with the banks now. And it has been growing more, and it has become significant part of the Indian financial sector. And followed by the HFCs, they are one of the largest receiver of funds from the banks and other public in terms of raising of funds for the onward lending to various segments. And in terms of importance of the NBFC sector, it has last 4 to 8 years, it has gained a lot of prominence and importance. especially post the ILNFS and DHFL issues. The regulatory purview on the NBFCs per se has been much more deeper, and it has assumed a lot of vigor actually. And as we all know that NBFCs borrow from markets in terms of bonds and commercial papers, and also from the banks. So a lot of public funds is involved in terms of their borrowings. So naturally there is a significant purview and role of the regulator in terms of monitoring and regulating these companies in the NBFC sector. In terms of the difference between banks and NBFCs, there can be two set of differences. One on the structural arbitrage which the NBFC enjoys, and on the other hand, the prudential arbitrage which the NBFC enjoys vis-a-vis the banks. In terms of structural arbitrage, I can say that unlike the banks, the NBFCs need not have CRR and SLR, and there is no requirement of priority sector lending, and no restriction on investments in shares of other companies, and there is no shareholding limit in terms of similar to the banks, and there is a FDI is allowed under automatic route. In terms of prudential arbitrage, unlike banks where licensing is subject to certain time period, NBFCs can be incorporated anytime subject to the approval of the RBI for commencing the business. And there is no ownership restrictions. Corporates can own NBFCs. Of course, RBI will look at in terms of number of NBFCs which a corporate can have, and there are no much of entry point capital requirement in for the NBFCs. And these are some of the regulatory arbitrage which the NBFCs have been enjoying over the banks. But however, having said that, post ILFS and DHFL issues where a lot of liquidity issues are arisen in the NBFC sector, and defaults have happened, and which has impacted the financial sector as well as the thought process of the regulator. Now the regulatory arbitrage between the banks and NBFCs are getting converged. So going forward, probably I see in next 3 to 5 years there will not be much of regulatory arbitrage between the NBFCs and the banks, given the kind of important and critical role these NBFCs play in the overall economy. And based on activities, as you all know, NBFCs are divided into deposit taking and non-deposit taking, and based on the size, they are divided into systemically important NBFCs. That is asset size. Based on asset size, 500 crores and above are termed as systemically important NBFCs, and asset size with less than 500 crores are termed as non-systemically important NBFCs. And in terms of the nature of activities, they can be further classified into core investment company, non-operating financial holding company, which most of the bigger NBFCs have this structure in place. And based on lending, they can be categorized as investment and credit company, MFIs, factors, housing finance companies, etc. And we all know that NBFCs have been regulated by RBI through various master directions. And in October 2021, they also brought in a new framework called scale-based regulatory framework, which is which has categorized NBFCs into base layer, middle layer, and upper layer and top layer of categories. These different categories of NBFCs are subject to various regulatory oversights in terms of their depending upon which category they fall into. And in terms of the development in the NBFC sector, 1998, there are few milestone years in the NBFC sector. One is year 1998, where categorization of NBFCs has taken place, and minimum credit rating and net own funds requirement was introduced. And in 2011, the asset size NBFCs with asset size more than 100 crores, now it is 500 crores, are termed as systemically important NBFCs, and prudential regulations such as capital adequacy requirements and exposure norms to other corporates have been introduced as a result of the Usha Thorat report. And in 2014, the minimum net own funds was introduced at 2 crores, and systemically important NBFCs it was increased to 500 crores from that 100 crores, and new corporate governance norms were also introduced. And 2021, now it has been the categorized into scale-based regulatory framework, and where the upper layer will be subject to intensive top layer will be subject to the intensive supervisory engagement by the RBI. Any company which is getting into the top layer, it can be considered as a risky to the sector per se, financial sector per se. And there are upper layer where currently there are about 16 plus NBFCs which have been listed in upper layer, which will be about 16 plus companies. And middle layer, there are about 300 companies, 300 plus companies. And in base layer, I think it's about 9,000 companies, as on the March. So these are the these are my introductory points, and I'll leave it to Ms. Deepthi.
Thank you, Sam. Sudha, and then.
Yeah. Good morning, participants, and good morning, everyone. And as I have informed earlier also that NBFC is a specialized field, and very few company secretaries have expert knowledge of NBFC companies. In fact, Shan is, whenever I remember about NBFC company, Shan is the only professional who comes to my mind. And unfortunately, we could get 2 of his dates last week as well as this week also to be a panelist. And by now, you may appreciate that whatever I have said, that it is true. And especially in case of prudential norms for the systemically important deposit accepting as well as non-deposit accepting companies. As I informed earlier, if you are working for a listed company, you have to be familiar with listing regulations apart from the Companies Act. Similarly, if you are working for an NBFC company, you have to be familiar with the NBFC regulations apart from the Companies Act. Normally, we say that always listing regulations are very complicated. Once you try to understand NBFC regulations, you will feel that SEBI regulations are very easy and they are not complicated at all. Because understanding the prudential regulations is very, very difficult according to me. And the master circular, whenever it comes, it runs to about 60 to 75 pages. And it's very, very complicated, right from the definitions onwards, that to understand what kind of ratios you have to maintain, to understand what kind of prudential norms you have to comply with. And anywhere anything goes wrong, you will have yearly inspections and the RBI will take you to task. So it is up to the company secretaries. If anyone wants to develop a niche area for themselves, this is one area which is available. And definitely that, of course, whenever you develop a niche area, obviously that the opportunities, some people say that if you are specialized in a particular field, opportunities may not be more. But there are people who are specialized in this particular field also, and Shan is one of them. And there are about some other 10 to 15 professionals whom I know who got expertise in this particular field. I must confess that I have working knowledge definitely as far as NBFC's companies are concerned, but I don't have an expert knowledge as such. So that's why I can't. I'll give a pause here and request Bala to take it further. Thank you.
Good morning to all of you. It is always a pleasure to welcome you all on my behalf and also on behalf of Mehta and Mehta. We heard 2 experts elaborately talking on the NBFCs and its importance, the type of NBFCs, etc. After that, I have nothing much to add except to talk about why these prudential norms. Because the prudential regulation, which is basically designed to have a preemptive approach of any crisis instead of sorting up the crisis after the event has taken place. As you know, prevention is always better than the cure. So once the event takes place, then it takes a lot of time and energy for the companies to sort out the issues, etc. And all this thing, it runs into various litigation issues, etc. and other thing and all. Basically, the prudential norm, which has been brought by the regulatory affairs from time to time, which has been coming, it decides to address the problem which are likely to emerge. And how do you address the thing? How do you take the action? How you actually, get rid of the harms or at least minimize the harms? To that extent, the prudential norms have come actually. Really speaking, our presenter and other people are going to talk about all those things. Because when we talk about the money involved in the bank and the NBFCs, is basically the loan which is there. So what happens is the loan actually become an asset in these companies. Unless in the other companies, loan is actually a liability. In this company, loan is an asset. When the loan is an asset, it is expected to perform something. When the loan is an asset, when you say when it is performing, if the EMI is coming in time, interest is coming in time, everything is time, then it is actually a performing. That means they call it as a standard asset. Accordingly, they classified various things: standard asset, substandard asset, non-performing asset, etc. Another thing and all. The Prudential norm try to address. You first classify what are the things accordingly to take an necessary step so that any crisis that can be prevented. That is the whole idea about the Prudential norm which is there. So really speaking, it will be easier to address the issues pre-hand it is happening, which will be rather less costly, less time consuming, rather than sorting out what the event has taken place. That is the whole idea. Another thing is that NBFC is being a financial sector, it has been growing, as Mr. Sean was telling. It has been actually growing larger and larger. In fact, not only the NBFCs are only for the thing, but the thing is NBFCs is also there within the group who are holding the securities on the group. That is intercompany group, investment, etc. Other things are also there. So to that extent, there are some exemption which has been actually given. That is what he was talking about, is systemically important NBFCs, etc. So as we go along with the presentation, we will hear more about the Prudential norm, what is the important, etc. and all these things. I think there are a lot of things are there in Prudential norm. We may not be able to discuss everything, but although we will pick up what is very important, we will pick up, because if we have to discuss everything, we will have to take 2-3 sessions. That may not be possible. So today we will actually run through what is the Prudential norm. Important things we will actually discuss. Your queries are welcome. You please put your queries on the chat box. We can address then and there. I give a pause here and I ask Aditi to take over.
So Aditi, before you take over, let me also add that this is the last webinar in the series of masterclass on NBFCs, and from next week onwards, we are going to start masterclass on SEBI listing regulations. And since long, people are requesting us to organize a masterclass on the listing regulations, especially. So we thought that because SEBI listing regulations are such that there are a lot of amendments used to come. At least 6 to 7 times the listing regulations got amended on an average basis for the last 3-4 years. So we thought it is appropriate for us to run a masterclass now. So from next Saturday, we are going to start that masterclass on SEBI listing regulation. This is going to go for about 10 to 12 weeks, if not more. We will be coming back to you soon with the announcement and everything. Thank you.
Yeah.
Yes, sir. Shall I start my presentation now?
Yeah, please.
Yeah, definitely can start.
Yes. Good morning, everyone. I welcome you all here. I'm very glad and honored to have all the panelists, fraternity, and members of Mehta and Mehta. So the topic of my presentation today is prudential and governance norms for non-banking financial companies. To begin with, let us first understand in brief what is prudential norm. So prudential norm is a combination of laws and rules which is intended to reduce the risk that bank and non-banks take on to ensure the safety and soundness of both specific institution and the system as a whole. So prudential norms are regulated and provided by the RBI. They are the guidelines and norms on income recognition, asset classification, and provisioning pertaining to advances. Banks are required to recognize incipient stress in the borrower account and classify them as special mention account, and if required, subsequently classify them as NPAs. So what is SMAs? SMAs means assets or accounts that show symptoms of bad asset quality in the first 90 days itself or before it being identified as an NPA. Moving further, a master circular is issued by RBI for prudential norms on income recognition, asset classification, and provisioning pertaining to advances, while master circular dated 1st April 2022 consolidating the instruction guidelines issued to the banks till March 31st, 2022 on matters relating to prudential norms on income recognition, asset classification, and provisioning pertaining to advances. Once again, a master circular consolidating the instruction on the above matters was issued up to the March 31st, 2023 by RBI. So the following are the types of NBFC based on ability to accept the deposits, that is the deposit taking NBFCs and non-deposit taking NBFCs. Further, the non-deposit taking NBFCs are classified based on the size, that is systemically important NBFC and non-systemically important NBFC. Systemically important NBFC are those with asset size of rupees 500 crore or above. And non-systemically important NBFCs are those with asset size of less than 500 crore rupees.
Aditi, if I may just pitch in a little bit here.
Yes.
For the participants, I would like to clarify that despite the introduction of scale-based regulatory framework, this kind of classification is also still relevant because for various categories of NBFCs, different master circulars, master direction issued by RBI is still applicable. Only to the extent of changes, exceptions introduced in the SBR will become relevant. So if you are looking at an NBFC and if you're looking at the regulatory aspects, which all things you'll have to follow, you have to follow all the RBI master direction issued for the systemically and non-systemically important NBFCs, in addition to the scale-based regulatory framework which was introduced in 2021. So SBR is something which is over and above, or it could have carved out something from the master directions. So master directions issued by RBI at various points of time is still relevant, and this classification also still holds good despite the SBR. Go ahead, Aditi.
And just just one more thing to add, Sean, is that as far as the RBI prudential norms or any of the regulation, NBFC regulations are concerned, it doesn't depend upon the type of the company, like your private company or a public company, but it always depends upon the asset size of the company.
Exactly.
What kind of compliances you have to go with, it depends entirely on your asset size, nothing to do with your whether it is a private company or a public company or listed or unlisted company.
Correct.
That's why I mentioned last week also that even if you are working for a private company, a small company, you may be thinking that private company, but if that company's asset size is 500 crore or more, you will be doing as a company secretary much more work than a company secretary who might be working for even a listed company also. Yes, Shan, you are saying something.
Yeah, the systemically important NBFCs are subject to much more rigorous regulatory purview and regulations in terms of oversight.
Yeah.
Go ahead.
So in today's session, we are going to discuss the prudential and governance norms for systemically important non-deposit taking NBFC and deposit taking NBFC, and also for non-systemically important non-deposit taking company. And also we are going to have a brief discussion about the NBFC compliances relating to information technology. So let us first discuss the prudential norms for systemically important non-deposit taking company and deposit taking NBFCs. The first prudential norm is about the capital requirement. So every applicable NBFC shall maintain a minimum capital ratio consisting of tier 1 and tier 2 capital, which shall not be less than 15% of its aggregate risk-weighted asset of on-balance sheet and of risk-adjusted value of off-balance sheet items. The applicable NBFCs primarily engaged in lending against gold jewelry, where such loans comprising 50% or more of their financial asset shall maintain a minimum tier 1 capital of 12%. The tier 1 capital in respect of applicable NBFC other than NBFC microfinance institution at any point of time shall not be less than 10%. RBI-wide circular dated October 22, 2021 has introduced scale-based regulation for all the NBFCs and has classified the NBFC in 4 layers: base layer, middle layer, upper layer, and the top layer. NBFC upper layer shall maintain a common equity tier 1 capital of at least 9% of risk-weighted assets.
See, tier 1 capital primarily comprises of the primary capital which the NBFC puts in the business. It's basically comprises of equity and shareholders fund, which is reserves and surplus. This is the primary capital of the company, which will ensure that the company is adequately capitalized at different points of time, considering its exposure in terms of loans to various borrowers. Go ahead,
So
Aditi.
Shan, tell me one thing, that whether RBI, when you talk about the capital base, whether they give the equal weightage to both equity and preference capital, or preference capital is not given the equal weightage?
From the RBI perspective, they look at more at the equity actually.
Equity capital. Okay.
Yeah, they also look at the capital adequacy norms. So if you look at the most of the NBFCs will be constantly increasing their equity when their asset size grows actually. And companies with huge reserves, they often come out with bonus issues for capitalizing the equity actually. Go ahead, Aditi.
Yes. So following are the various prudential regulations. Let us discuss some of the important regulations. First is about the income recognition. So it must be based on recognized accounting principle. Income including interest, discount, higher charges, lease rental, or any other charges on NPA shall be recognized only when it is actually realized. Next is about the income from investment. So income from dividend on shares of corporate bodies and units of mutual funds shall be taken into account on cash basis. However, the income from bonds and debentures of corporate bodies and from the government securities or bonds shall be taken into account on accrual basis. Next is about the accounting standard norms. So NBFCs shall prepare their financial statement in accordance with the Ind AS as per company's Indian Accounting Standard Rules 2015.
This is one place where there is a difference between bank and NBFCs, where NBFCs are under much more rigor compared to banks, because banks till now this Ind AS is not made applicable, whereas for NBFCs it has been made applicable actually. Go ahead, Aditi.
Next is about the accounting of investment. So the board of directors shall frame and implement an investment policy for their company, and the criteria to classify the investment into current and long-term investment shall be set out in the investment policy. The policy on demands or call loans. The board of directors granting demand or call loan shall frame and implement a policy stating the cutoff date within which the repayment of the demand loan or call loan shall be demanded. Also, it shall mention the rate of interest. Next.
See, these demand loans, call loans basically would include business loans, trade advances, funding for inventories, can be loan against shares and other securities.
Yes. Next is about the norm for the asset classification provided by RBI. So NBFC shall classify its asset or loans in following classes, namely standard asset, substandard asset, doubtful asset, and loss asset. So I will define each of the following assets. So standard asset means asset where no default in repayment of principal or payment of interest is pursued. Substandard asset means an asset which has been classified as non-performing asset for a period not exceeding 12 months. Doubtful asset means an asset which remains a substandard asset for a period exceeding 12 months. Loss asset means asset which has been identified as such by the applicable NBFC or its internal or external auditor or by the bank during inspection.
Just like to pitch in on little elaboration on the standard asset. As Aditi has said, standard assets means there is no default, but the special mention account which was introduced by RBI in 2014, SMA 0, 1 and 2 also will form part of the standard asset. The objective of classifying this SMA, this kind of classification, SMA 0, 1, 2, is that these are the accounts. SMA 0 means it's up to 30 days where a default has occurred. SMA 1 means 30 to 60 days, and SMA 2 means 60 and up to 90 days. So these were denoted as special mention accounts, which was introduced by RBI in 2014. The objective of introducing this classification is to identify those assets which has the potential to become an NPA or a stressed asset. The logic of classification is that this can soon become an NPA, hence there needs to be a special monitoring, hence it is known as a special mention account. This is all tracked by the NBFCs, as and when an account gets into default into 30 days as SMA 0 and 30 to 60 as SMA 1, and the moment it goes to SMA 2, the potential of it turning into an NPA is very high actually. So the 60-day bucket is become very critical for the NBFC. So they monitor with a lot of special focus to ensure that it is it doesn't go beyond that.
So, Sean, you meant to say that when this asset classification takes place,
Mm.
that though one of the objective is to monitor that company, that NBFC company by RBI, but what exactly, suppose, for example, if a company is the substandard assets are growing, then any kind of equity infusion is mandated, or are any going to be any kind of penalties, or what exactly is going to happen?
See, there are various ways which you will manage the substandard accounts. One is that securitization, where you will sell these assets to a asset restructuring company. That way, you can take these assets out of your balance sheet. The other one is to create appropriate provision so that you write it off. So these are couple of avenues available to manage the substandard assets actually. Otherwise, it's going to impact your gross and net NPA.
So when you are determining a company as a systemically important company, okay, that time this 500 crore plus asset size is there. In that asset size, are you going to take all kinds of assets, or only the standard assets are going to be taken into account?
You are asking in terms of the AUM. Yeah, it will be all the assets actually.
All assets.
Yeah, all assets.
Okay.
Because it's all the receivables for the company only. It's a part of the loan
Correct.
asset. Go ahead.
Yes. Certain clarification has been provided by RBI on asset classification. So it provides that an amount is to be treated as overdue if it is not paid on due date fixed by the NBFC. The exact due date for repayment of loan, frequency of repayment, breakup between principal and interest shall be clearly specified in the loan agreement. Also, RBI has provided certain provisioning requirements. NBFC shall, after taking into account the time lag between an account becoming an NPA and its realization, so it shall accordingly make a provision against the substandard asset, doubtful asset, and loss asset. Next is about the standard asset provisioning. NBFC shall make provisions for standard asset at 0.4% by the end of March every year. NBFC of upper layer shall be required to hold differential provisioning towards different classes of standard asset. It need not be netted from the gross advances, but it shall be shown separately as contingent provisions against standard asset in the balance sheet. Next.
Nowadays, RBI is more focused on these, provisioning which are made by the NBFCs. They look at a specific parameter, provisioning coverage ratio, which is the ratio of provisioning to the gross non-performing assets. This will indicate how much is the extent of funds available in the NBFC to cover the losses arising out of the loans it has disbursed actually.
Next.
Aditi.
Yes. Next norm has been provided regarding for the multiple NBFCs. It provides that the NBFC that are part of a corporate group or are floated by a common set of promoters, they shall not be viewed as a standalone on a standalone basis. So the total asset of the NBFCs in a group, including deposit-taking NBFCs, if any, shall be aggregated to determine if such consolidated consolidation falls within the asset size of two categories, that is those of asset size of below 500 crore and those with asset size of rupees 500 crore and above. Also, disclosure needs to be done in the balance sheet. So every NBFC, applicable NBFC, shall separately disclose in its balance sheet the provisions made as per these directions without netting them from the income against value of assets. So the provisions shall be indicated under separate head of accounts. First, the provisions for bad and doubtful debts and provisions for depreciation in investment. The schedule, norm regarding the schedule for the to the balance sheet. So NBFC shall attach to its balance sheet the particulars in the schedule as set out in the annexure 4. Also, the loan against NBFC's own share is prohibited. Next, following are the Fair Practices Code applicable for both for the systemically important NBFC and non-systemically important NBFC. So let us discuss some of the important ones. Regarding application for loans and the processing. So loan application forms shall include necessary information which affects the interest of the borrower. It shall also indicate documents required to be submitted with the application form. Communication shall be made by the NBFC to the borrower in vernacular language or any language as understood by the borrower.
See, this fair practices code is something which RBI of late has become very critical in terms of compliance, because a lot of NBFCs now source customers through fintech companies also. So there have been some untoward incidents in terms of during the collection process and all that. So fair practices is a code which the NBFC is expected to adhere in terms of what it gives to the customers, how it deals with the customers, and how it shares the documents executed by the customers, and in terms of penal charges and other interest charges, whether it is disclosed with transparency, and in terms of collections, whether appropriate modalities are followed. All these comes under the fair practices code. From the RBI perspective, including the regular monitoring as well as during inspection, FPC assumes a lot of importance, and they look at the specific compliances of each of the directions issued under the FPC. And similarly, the communicating in terms of language to the customers. For example, NBFCs may be spread out pan India. They may be in different regions. So in case if the customer insists on a loan documentation in a regional language, the NBFC has to provide the same or provide a translation of the English language documentation provided to the customer. Go ahead, Aditi.
There is one query has come to you.
Yes.
I think Shashank is asking.
Yeah.
In case of the NBFC HFC, and which is SI-NBFC, whether it need to follow SI-NBFC direction and the HEC direction, both are only HFC directions.
See, any master direction or a circular issued by RBI, it will have an applicability clause actually. So one has to look at the circular. Sometimes there are common directions issued for all types of NBFCs. They will say it applies to HFCs also. Sometimes they will say it applies only to NBFCs. So one has to go through the applicability clause in the relevant circular or a direction, and then look at whether it is also applicable to HFC. But as far as HFC currently is concerned, like in over and above what I said now, HFCs have a separate distinct regulations issued by the NHB, National Housing Bank. But in terms of the scale-based regulatory framework, if the HFC falls under a particular categories or say upper layer or middle layer or base layer, they will have to be mindful of the guidelines issued under the scale-based regulatory framework also.
There's one more question is there. Usually of the shares at the premium by an NBFC is regulated by the Companies Act 2013. Any provision in the RBI regulatory framework?
I don't think there is anything specific under the RBI regulatory framework. This will be subject to the Companies Act provisions only.
Yeah, you are right. I also agree with that. Yeah, go ahead, Aditi.
Yes. Next is regarding the loan appraisal and terms and conditions. NBFC shall give to the borrower in written, ideally in vernacular language, the terms and conditions, the amount of loan, and the rate of interest. Next is the penal charges in loan accounts charged by the NBFC. So penal charge for non-compliance of material terms and conditions of loan contract by the borrower shall be treated as penal charges. However, there shall be no capitalization of penal charges. Also, this will not affect the normal procedures for compounding of interest in the loan account. Next is about the disbursement of loans, including changes in terms and conditions. Any change in terms and condition, including disbursement schedule, interest rate, maybe service charge, prepayment charges, etc., shall be communicated to the borrower. Also, the changes in interest rate and charges shall be charged prospectively. Next is regarding the responsibility of Board of Directors. The Board of Directors must provide for a periodical review of the compliance of the fair code practice and the functioning of grievance redressal mechanism. Appointment
This fair practices code compliance, this is comes under the purview of board as well as the risk management committee. So most of the NBFCs, as a quarterly process, they do put a compliance of the fair practices code to the risk management committee. This is also put up as a part of the agenda of the board meeting also. Go ahead, Aditi.
Yes. Next is practice regarding the appointment of grievance redressal officer. So NBFC shall display at their places or branches where their business is transacted the name and the contact details of GRO. And if the complaint is not redressed within a period of 1 month, the customer may appeal to the officer in charge of the regional office of Department of Supervision of RBI. Next is regarding the practice for language and the mode of communicating fair practice code. It must ideally be in vernacular language or a language as understood by the borrower. Also, it must be published on the website of NBFC if any. Shall I move to next slide, sir? So the following are the specific directions applicable to NBFC microfinance institution and microfinance loans of applicable NBFCs. So the entry point norms for NBFC MFI states.
And what is what is this microfinance company? May any particular specific classification is there on what basis?
Yeah, microfinance companies are, the companies which lends, to the ticket size of the loans will be very small. It gives loans to various individuals, on a short term. It could be short term also. There are specific microfinance companies. These are subject to specific regulations of RBI. Actually, this will not be similar to like the systemically important NBFCs or middle layer NBFCs or like that. They have a separate regulatory oversight of RBI actually.
I think basically they lend money to the small-time traders and
traders. It could be individuals. It could be small business people.
Yeah, microfinance is
proprietors like that actually.
It is probably meant for only the low-income group of individuals who are otherwise it doesn't have the access to go to the bank. When you go to the bank, you have to comply with a lot of requirements, etc., in terms of the surety, in terms of your mortgage, etc., and other thing and all. Here, this is actually the lower income group where so much things are there, but only thing is, depending upon the risk pursued by this microfinancing company, they take the risk.
Yeah, the customer profile will be quite different in terms of you'll not be able to the credit standing of the customer will not be similar to that of the bank customer actually. So
Normally
in terms of risk to the NBFC MFI, it will be quite high.
Normally, they provide for the small business people, like, somebody starts a small business, etc. They may not be able to pledge any property. They may not be able to give one thing. Only looking at the business, their capability, etc., and all the things, pursuing the risk level, they actually pursue. Normally, it is for the lower income group of people. In fact, there are a lot of microfinancing companies which are actually helping in the rural areas for the ladies who are doing some sort of the business, etc., and other thing and all. They are lending a loan.
Actually, in the good olden days, if I'm not wrong, this microfinance companies used to be mostly in unorganized sector. Subsequently, they have been brought into the organized sector.
Correct.
See, what happens is the moment when they're in the unorganized sector, that the exploitation used to be more, that people used to do the arm twisting and all for recovery of the loans and all those things, then heavy rate of interest. So there was no proper regulations at all, So microfinance companies, basically, they have been brought under the RBI umbrella is to bring them into the organized sector. Yeah.
Mm-hmm.
So first are the entry point norms for applicable for NBFC MFIs, which states that all new companies desiring registration as NBFC MFIs shall need a minimum net owned fund of rupees 5 crore. However, those in the northeastern region of the country will require net owned funds of rupees 2 crore. The following are the prudential norms. Such NBFC shall maintain a capital adequacy ratio consisting of Tier 1 and Tier 2 capital of not less than 15% of its aggregate risk-weighted assets. Also, the total of Tier 2 capital shall not exceed 100% of Tier 1 capital. Asset classification and provisioning norms mentions that an asset may be classified as standard asset or NPA. NPA means an asset for which interest or principal payment which has remained overdue for more than 90 days. It also provides that the aggregate loan provision shall not be less than higher of A, 1% of the outstanding loan portfolio, or B, 50% of the aggregate loan installment which are overdue for more than 90 days and less than 180 days, and 100% of the aggregate loan installment which are overdue for 180 days or more. Next direction are for the channelizing agents of schemes operated by the central or state government agencies. These agencies shall abide by certain guidelines which state that the loan managed in the capacity as channelizing agent for central or state government agencies shall be considered as a separate business segment. And all such loans shall be reported to credit information companies to prevent multiple borrowings. Also, the accounts and records for such loan shall be maintained in a distinct book. Next direction provides for the geographical diversification. So these NBFCs shall approach their boards for fixing internal exposure limits to avoid undesirable concentration in specific geographical location. Next direction provides for the formation of SRO, self-regulatory organization. So these NBFCs shall become a member of at least one self-regulatory organization and shall also comply with the code of conduct prescribed by the SRO. This is about the monitoring. Yes, sir.
Someone is asking here, is it mandatory for India to apply the Basel norms in their banking system?
Yeah, banks, they are subject to Basel III norms now. In fact, in NBFCs, middle layer and upper layer, for their capital assessment, they have to go by what is applicable to the bank. The July 2015 circular on Basel III norms, this capital assessment that is also applicable for NBFCs also. Banks have been brought under the Basel III norms actually.
Is the fair practice code applicable to the non-lending NBFC SI also?
Non-lending, if it is an investment company, it may not be relevant actually. Core investment.
I think yes. I think fair practice code is applicable to NBFCs having customer interface only.
Yeah, core investment companies, it may not be relevant actually.
Yes, yes.
How to calculate the net owned funds?
There is a definition given under the RBI Master Directions dated July 2015, where it talks about net owned funds actually. So one has to go by the definition.
What are the elements of the net owned funds covers? Yeah, that you have to go by the circular. That's what you said.
See, it basically comprises of equity or convertibles less than 5 years reserves and surplus, then deducted by the investments in other NBFCs and investments and loans to the other group companies.
Is there any regulation on the maximum rate of interest?
There is no specific rate of interest, ceiling prescribed by the RBI actually. But when the interest rate is quite high, they look at it from the fair practices code perspective. That's all. I mean, if I understand right, especially fintech companies and all, they charge close to 30 plus 36% actually.
Okay, go ahead, Aditi.
That actually, terms of lending is concerned, nowhere RBI comes into picture.
Yeah, there is a possibility that the states may have state-specific laws. So one has to be
Correct.
mindful of that.
Yeah.
Next is about the monitoring of compliance by such NBFCs.
But sorry, 1 minute, Aditi. Shan, if I am not wrong, even for NBFC companies also, the deposit rules of Companies Act is applicable, or they comes under the exemption rules?
Deposit rules, it is also applicable. They will have, see, there are two, in terms of deposit, there are two kinds of regulatory aspects which the NBFC has to be mindful. One is as per the Companies Act, as well as one is as per the RBI deposit regulations.
So NBFC companies, if I am not wrong, they are not exempted from the deposit rules under the Companies Act. Am I correct?
Yes. Whenever they invite deposit, that advertisement and all that, they also do publish.
So they have to be qualified to invite deposits also.
DPT3.
Yeah.
All that is relevant.
Yeah. See, because sometimes what happens is people are under the wrong impression that for NBFC company, deposit rules are not applicable. They are equally applicable.
It is
But
very
the
much
only thing is, if I am not wrong, that for the NBFC companies, that also depending upon the investment company and lending companies, 186 applicability is exempted. Not a blanket exemption, but
Correct.
if it is an investment company, as far as the investment restrictions are not applicable, if it is a lending company, lending restrictions are not applicable.
Yeah.
So that one has to see that 186 subsection 11 for that. Yeah.
Go ahead, Aditi.
Yes. Next is about the monitoring of compliance by such NBFCs. So the responsibility for compliance to all regulation lies with the NBFC themselves. The industry association or SROs shall also play a key role in ensuring compliance with the regulatory framework. Certain directions for microfinance loans has been provided by RBI. So these NBFCs shall be guided by the RBI regulatory framework for microfinance loan directions 2022. Next, we are going to discuss the governance norms for the systemically important non-deposit taking company and deposit taking NBFCs. So following the first governance norm is about the acquisition or transfer of control of applicable NBFCs. So a prior written permission of the RBI shall be required for any takeover or any acquisition of any control, or if there is any change in shareholding which results in acquisition or transfer of shareholding of 26% or more of the paid up equity capital of NBFC, or if there is any change in management. Next is about the application.
Change in management here would mean that there is a change of 30% in the director board composition basically, and it excludes independent directors. And in terms of this 26%, one has to keep track of these changes, because existing corporate shareholders in the NBFC, if they already have some 20% plus around that, one has to be mindful of this trigger. Inadvertently, this trigger should not be breached, because this requires a prior approval of RBI, and it takes about 1 to 2 months time to get the RBI approval.
Balaji is asking, kindly also cover about the guide path criteria.
Glide path in the sense, as of now, this scale-based regulatory framework has become applicable. Only glide path, I think, is available for the core financial services solutions, where NBFC is also expected to have a core banking solution similar to the banks. I think for that, there is some time available till March 2025, and each NBFCs have to provide a quarterly progress report to the RBI.
Also,
even for net owned funds, I think glide path is available for the increase in the net owned funds of microfinance institutions.
Yeah, I think that is available for the base layer. Similarly, for the NPA norms, this 90 days is not applicable to base layer now. I think it becomes applicable from March 2026. Whereas for the middle and upper layer, this 90-day norm has become applicable.
Also, under the income recognition, you said that the interest income should be realized only when realized, but there is an accrual system of account on the cash basis only in case of the NBS. Did I get it correctly?
No, when there is a specific sectoral regulation applicable to you, you'll have to adhere to that.
Okay. DPT
For
3.
instance, your provisioning norms under NBFC directions are, for NBFCs are much different from, what is being provided in the Companies Act. In some of the lease and hire purchase assets, the depreciation rates are also specified. So this will apply over and above what is provided under the Companies Act.
DPT 3 is not applicable to NBFCs. That's what Sudhakar is saying. I think the exemption has been given for the government companies and the banking institution on the NBFC, I think so. Am I correct?
Which one, sir?
DPT 3 is not applicable to NBFCs.
Yeah, DPT 3, it is given in the rules itself, actually.
Yeah, exemption has been given, specifically exemption given for the government companies, banking companies, and also the NBFC. That is there, I think. Yeah.
DPT 3 is not applicable.
Please explain the mandatory requirement that a branch will have to follow.
See, in terms of the branch requirements, you will have to have a compliance registers for the customers. You will have to give put up the FPC, display the FPC in the branch offices, and you will also have to give the details of the grievance redressal officer of the company, and you'll also have to put up a notice board on the ombudsman scheme of the RBI, where the customer is not satisfied with the resolution by the company, so that he can go to the RBI.
Relating to the deposit provision in the Companies Act 2013, as per section 73(1), on and after the commencement of the Act shall invite, accept, and renew deposit under this Act from the public, except in the manner provided under this chapter, provided that nothing in this section will also apply in a banking company, as defined in the Reserve Bank of India 1934 Act.
The question is missing.
Yeah.
Next question is from other participant.
Yeah. I think this is some Ashwath is asking this question.
Mr. Harshvardhan, your question is not complete.
Yeah. Is there?
You can take next and
okay. How will the calculation of the 30% change is actually done if it is even based in the financial year wise?
It is not necessarily a financial year. As and when there is a board composition change, you will have to be mindful whether the change is about 30%. Changes leads to 30% change. So the moment it triggers that, you will have to go to the RBI.
Yeah, in fact, this particular topic was discussed elaborately in our last webinar. So people can go through the recorded version of the webinar. We elaborately discussed on this particular matter in the last webinar.
For example, if the board composition is such that it has the non-executive directors and independent directors, and if you are going to induct a new non-executive director, it is possible that it may trigger a 30% change. So in that case, the new non-executive director cannot be appointed without the prior approval of the RBI.
In fact, the last webinar, Sudhakar also touched upon where you have the directors, 3 directors there. One of the directors is actually going 1/3. It is coming under the violation of the company clause. What to do, the precautions which are to be taken. I think he elaborately talked on this last seminar, I think.
See, Sean, Harshvardhan, I think this boy is asking for the one thing that as per section 73(1). Well, I'm referring to 73(1). Actually, 73 subsection 1 says on or and after the commencement of this act, that is Companies Act 2013, no company shall invite, accept, or renew deposits under this act from the public except in the manner provided under this chapter. That is chapter 5, which deals with acceptance of deposits by
yes.
companies, right?
Yeah.
Provided there is a proviso is there for this section, provided that nothing in this subsection shall apply to a banking company and a non-banking financial company as defined under the Reserve Bank of India Act 1934. And as such other blah 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 blah. So that means if a company is that is a non-banking financial company as defined under the RBI Act 1934, this chapter is not applicable to them. In fact, that was the confusion I had actually, whether it is applicable or not applicable. And though initially we were thinking it is applicable, but now it seems to be that as far as the chapter 5 of Companies Act, it seems to be not applicable to NBFC companies.
No, we will clarify that in the meanwhile.
Yeah, sure.
We understand that there is a minimum of rupees 5 crore to be maintained by 2025 and progressively it increases. Please clarify this aspect.
This is for which one, sir?
But this has been specified in the scale-based regulatory framework only. Okay, till 5 crores has to be maintained till 2025 and it will become 10 crores by 27.
That is
This
net owned funds, no?
NOF?
Yeah, net owned funds.
Yeah,
Yes,
net owned fund,
NOF.
net owned funds, basically. It is that it is increased up to the maximum of 10 crores now.
Yes. So we have already talked about that.
That means those companies which have to continue to be in the business of this non-banking finance activities, then they have to ensure that the net owned funds are increased to the desired levels.
Mr. Bala, you are on mute.
Sorry. What could be the reason for levying penalty as the penal charges on loan accounts instead of penal interest?
No, now RBI has issued guidelines that you can levy penal charges but not penal interest. Penal interest is over and above the interest you are already charging. NBFCs have been levying that, but recently, I think about 6-7 months back, there was one separate circular issued by RBI, wherein it has clearly said, you cannot levy penal interest. And it has a very detailed circular as to what all can be levied, what can be, made as a part of the, monthly dues and all that.
Base layer NBFC NPA criteria is 180 days. And will it shift to 30 days every year to move towards 90 days? Is it correct?
See, as of now, it is 180 DPDs, which is days past due, till 31st March 23. By 31st March 2024, it will decrease to 150 days. 2025 March, it will decrease to 120 days, and 31st March 2026, it will be 90 days, similar to all other NBFCs. So that is the glide path.
Whether one CCO can be appointed for all group NBFC CIC?
There is no specific provision, dealing this query in the RBI directions. But from the RBI regulatory perspective, they feel like, their view is that if an NBFC is a regulated entity, so a person who is appointed in an NBFC is expected to focus only on that particular NBFC. He should not, devote his time to the other companies. That is the, in principle, stand which they take.
As per this provision, whether the deposit provisions are applicable to NBFC. The same, Arshwardhan is asking that. I think you talked about that, I think. Where is the new shareholders or a non-resident, the RBI will carry out detailed due diligence on the new shareholders prior to the granting the approval. Need clarity on this statement.
No, FBI is under automatic route, no?
He says our understanding is that the due diligence in new shareholder only happens in case of the change of the control. Please confirm. If there is no change of control.
At the time of change of control, you will anyway go to RBI. At that time, they will ask the shareholder details, KYC and all that.
If there is no change of control due to the induction of the non-resident shareholder, only RBI intimation is required. As part of the intimation, do we have to submit due diligence documentation?
No, not necessary. There is a half-yearly FDI statement submission, which is submitted to RBI, and the year end it also gets certified by the statutory auditors. In that, you will have to give only the shareholding details in terms of what was the last change, what was the last shareholding in terms of the last reported data, and what is the current shareholding and the change. That is all.
Again, he is saying, 1 minute.
Yeah. Then due diligence documentation, generally RBI doesn't insist, there is no requirement as per the directions, but on a case-to-case basis, RBI may also seek some information in case if it is sought, one have to give.
Once an event of change of control gets triggered, whether we allow to get the due diligence should be all existing shareholders plus new shareholders, or due diligence will be restricted only to the new shareholder because of which change of control event is triggered.
See, there is a specific set of information to be submitted as per the acquisition or transfer of control chapter under the RBI Master Directions, dated September 2015. So one has to go by the requirements specified therein actually, and the RBI may also seek further data or information during the processing of such application.
Scale-based regulation mentioned about the glide path for existing NBFCs. What about the net owned funds for the new NBFCs? Nothing is mentioned in the circular for new ones.
No, new NBFCs, depending upon which category or which size you come under, you will have to adhere to the net owned funds requirements.
Okay, go ahead, Aditi.
So the next norm is about the application to be submitted by NBFC for prior approval. So it shall submit an application along with the following documents for obtaining a prior approval of RBI. First, the information about the proposed directors or shareholders. Secondly, a document disclosing about the sources of fund of the proposed shareholders acquiring the shares in the NBFC. Also, a declaration by the proposed director or shareholders that they are not associated with any company shall be attached. Next, declaration by proposed director or shareholders that they are not associated with any unincorporated body that is accepting deposits. Lastly, a declaration by the proposed director or shareholders that there is no criminal case against them. So these all documents need to be submitted for prior approval of RBI. Next norm is about the requirement of prior public notice about change in control or management. So a public notice of at least 30 days shall be given before effecting the sale or transfer of shares or transfer of control. So just a second, I am not able to move to next slide. Just a second. Next, we are going to discuss the prudential norms for non-systemically important non-deposit taking company. They are similar to the prudential norms for systemically important non-deposit taking NBFC and deposit taking NBFC, which we have already discussed, except the norm regarding the leverage ratio. So it provides that the leverage ratio shall not be more than 7 at any point of time. Next are the governance norms for the non-systemically important non-deposit taking companies. They are also the same as discussed for systemically important non-deposit taking NBFC and deposit taking NBFCs. So next we shall discuss about the appointment of Chief Risk Officer. With the increasing role of NBFCs in direct credit intermediation, there is a need for NBFC to augment risk management practices. So NBFCs with asset size of more than rupees 5,000 crore in categories of investment and credit companies, infrastructure finance companies, MFIs, factors, infrastructure debt funds shall appoint a CRO with clearly specified roles and responsibility. The CRO is required to function independently and ensure high standard of risk management. CRO shall be a senior official in the hierarchy of an NBFC and shall possess adequate professional qualification and experience in the area of risk management. The CRO shall be appointed for a fixed tenure with the approval of board. The CRO can be transferred or removed from his post before completion of his tenure only with the approval of board, and such premature transfer or removal shall be reported to the Department of Supervision of the regional office of the bank under whose jurisdiction the NBFC is registered. In case the NBFC is listed, any change in the tenure of the CRO shall also be reported to the stock exchanges. The board shall also put in place policies to safeguard the independence of CRO. The CRO shall have a direct reporting lines to the MD and CEO or the risk management committee of the board. In case CRO reports to the MD and CEO, the risk management committee of board shall meet the CRO without the presence of the MD and CEO, at least on a quarterly basis. The CRO shall not have any reporting relationship with the business verticals of the NBFC and shall not be given any business target. There shall not be any dual hating. That is, the CRO shall not be given any other responsibility. The CRO shall be involved in the process of identification, measurement, and mitigation of risk. All credit products, whether retail or wholesale, shall be vetted by the CRO from the angle of inherent and control risk. The CRO's role in deciding the credit proposal shall be limited to being an advisor only. If CRO is one of the decision makers in the credit sanction process, the CRO shall have a voting power, and all members who are part of the credit sanction process shall individually and severally be liable for all the aspects, including the risk perspective relating to the credit proposal. These are certain disclosure and transparency norms which shall be followed by NBFC. So all NBFC shall put up to the board of directors at regular intervals such policies, which includes the progress made in putting in place a progressive risk management system and a risk management policy and strategy followed by the NBFCs. Regarding the conformity with the corporate governance standard, that is the composition of various committees, their roles, responsibility, periodicity of the meetings, and compliance with the coverage and review function, etc. Also, the applicable NBFC shall also disclose in their annual financial statement with effect from 31st March 2015 the following, that is the registration or license authorization by whatever name called obtained from the other financial sector regulators. Regarding the disclosure regarding the ratings assigned by the credit rating agencies and migration of ratings during the year, and also regarding the penalties, if any, levied by any regulator. So the following are the various types of risk which may be faced by the NBFC. Liquidity risk. So it is the risk of non-availability of cash with the borrower to pay off a liability. Credit risk, that is the risk that a borrower will fail to repay the loan. It may also face interest rate risk, that is the risk of change in the interest rate. Risk on collateral, that is the risk that collateral will not fetch the expected value. Some other risks are operational risk, regulatory risk, reputational risk, compliance risk, outsourcing risk.
See, in terms of liquidity risk, RBI has specific guidelines on liquidity coverage ratio, where they specify that NBFCs have to have investments in high quality liquid assets to survive any stress scenario, which is for about 30 days. So this high quality liquid assets means the assets which can be readily sold or immediately converted into cash. Primarily, it will be government securities or sovereign funds, basically. So this liquidity coverage ratio is something which RBI critically examines during the inspection process as well as on a regular monitoring. And in terms of operational risks and compliance risks, there are specific guidelines of RBI such as FPC, KYC, and other specific provisions in the RBI master direction which takes care of the operational risks. In terms of compliance risks, now they have mandated the NBFCs to appoint chief compliance officer effective 1st October 2023. So this aspect of the risk is also getting monitored by the RBI through appropriate professionals now. In terms of outsourcing risk, there are specific guidelines issued by RBI for outsourcing activities, which clearly says that core activities like finance, compliance, internal audit, all that cannot be outsourced. Only certain business processes can be outsourced. Again, KYC verification cannot be outsourced, and they have a detailed guidelines for outsourcing in terms of what is the code of conduct to be followed by these outsourced agencies and all that. Go ahead, Aditi.
So now let us discuss the NBFC compliances relating to IT in brief.
How will the role of the chief compliance officer can be identified?
Yeah, there is a separate circular issued by RBI. What is the role of the chief compliance officer in terms of, if I have to give a brief on that, basically he will be the monitoring the overall compliances within the organization. Each function will be responsible for its compliance. For instance, in an NBFC, most of the functions do some sort of compliance. HR does some compliance. Credit function does some compliance. Operations team, they do take care of compliance relating to FPC, KYC, and all that. And finance and treasury functions, do a lot of compliance relating to accounting and liquidity and all that. And apart from that, the secretarial function takes care of the governance and board related compliances and committee related compliances. So the role of CCO will be to monitor all these compliances, assess the risk arising out of non-compliance, and also update various functions on the regulatory developments, and then report it to the various committees and the board. And RBI circular, clearly, spelled out what is the expected out of the chief compliance officer. One can refer that circular.
At the
Yeah,
same
if I
point
understand
of time,
correct,
Sean,
if I understand
one
correct,
minute, Bala, 1 minute. At the same point of time, though
Yeah.
listing regulations as such has not envisaged the role of a chief regulatory, the chief risk officer, but it has envisaged the role of the risk management committee, and a lot of responsibilities have been given to that committee. And especially when you are identifying the risks, cyber risk is one such risk, which listing regulations are given a lot of importance. And same is the case with even the RBI regulations also.
Yeah,
So,
because your entire data and everything is, which the company is very much dependent on for the day-to-day operations.
correct.
So this cyber risk and has assumed a lot of importance.
So in case the NBFC company is a listed company, you have to ensure that both the regulations compliances are to be synchronized completely.
Correct, exactly.
So it's a big job for a chief risk officer.
Yeah, basically the chief risk officer has to identify the risk and also find out the ways and means of mitigating the risk and ensure the threat of the enterprises is averted. That is what the chief risk officer. When the compliance officer said he take care of all the regulations and rules, etc., and also what he required under the various acts. As Sudhakar put it earlier, if we are a listed company, SEBI regulation, we are a companies act, with the RBI regulation, RBI compliance, so all those things he takes care of it. Whereas the role is the chief risk officer, totally different than the chief compliance officer. Can we outsource the finance, legal, HR work within the group company?
Legal and HR you may be able to, not finance. Core finance functions are not permitted to be outsourced.
Company secretary be the chief compliance officer.
And Sean, same is the case with IT also. And if you are outsourcing the IT, then there is separate compliances are there for that particular purpose.
Yeah, IT, by and large, most of the companies like, data server management, everything is all outsourced only. One has to go by the RBI master direction on the IT framework.
Correct, yeah.
Company secretary be the chief compliance officer. Will it count in the dual hatting?
Yeah, even some of the upper layer companies have designated the CS as the CCO. There's there's no problem in that because company secretary also has a role of assurance function. So this will not be considered as dual hatting. Actually, dual hatting means you cannot do something on the business side as well as play a devil's advocate.
See, suppose if the company secretary is going to be a chief risk officer, it may be considered as a dual hatting at that point of time because the role of a chief risk officer is entirely different. Whereas the company secretary playing the role of a compliance officer, it may not be considered as dual hatting.
Correct.
Digital Personal DTA Protection Act 2023 also need to be followed by the NBFC.
Yeah, it has to be followed by all the companies.
Can we outsource service as the chief technology officer?
Now, some
I
of the
don't know what
IT related services you may be able to outsource, but not because each company, in fact, for the IT, there are multiple chief CXOs are mandated, chief information officer, chief technology officer. The guideline says, various designations actually.
Tech can be outsourced within the group.
Yeah, if I'm not wrong, Shan, that chief technology officer role can be within the group, it can be outsourced. But I think as you rightly said, there is a master circular directions are there as far as this outsourcing of IT is considered. Because if I'm not wrong, at Reliance, we used to have one common CTO for 3 NBFC companies.
Okay.
Yeah.
In fact, I don't know, correct me if I'm wrong, because I have seen some companies, what they do is they create a subsidiary company. They actually say, XO is IT and management services company. And they actually give all these services to the subsidiary company. And they actually perform. In fact, this is within the group with the subsidiary only. I think that is permitted, I think so.
Yeah, when
Yeah,
you're
but only thing
outsourcing,
is, but the only thing is one has to see, because these particular regulations are constantly getting changed every year. So don't go as per this, at any point of time, if you are in doubt, please refer to the respective regulations before you are implementing anything. Don't go as per this webinar, whatever we are saying it, because lot of water has flown down the river and down the bridge. In fact, in the past 2-3 years,
correct.
And as I was mentioning that RBI is giving a lot of importance to the information technology related activities as well as the cyber security related activities. And if to a large extent, yes, answer is you can outsource the things, but subject to certain things. The outsourcing company also have to have the ability to handle the technical related issues. And at the same point of time, what kind of what's called as the softwares and all though they're having a lot of things are there. So it is not like a simple outsourcing thing. You have to please go through the circular thoroughly before you outsource it.
Yeah, especially when you're outsourcing within the group, you'll have to be careful on the arm's length pricing. There needs to be proper contracts and all that, because NBFCs raise a lot of public funds. So RBI is very critical on when you're transacting with your group companies.
Yeah, go ahead, Aditi.
So let us first discuss the policy regarding the information security policy. So NBFCs are required to formulate and implement a comprehensive information security policy that addresses data security, access control, data confidentiality, and cyber security. Next, it provides for data protection and privacy. So NBFC must comply with the data protection and privacy regulation, including the Personal Data Protection Act when it comes into force. It must safeguard the customer data and personal information through encryption, access control, and data retention policies. Also, the NBFC must have a cyber security framework in place, which includes measures to detect, prevent, and respond to cyber security threats and incidents. It must conduct regular vulnerability assessments. Next is regarding the security incident reporting. So it must establish procedures for reporting the security incidents. It must notify the RBI of any significant security incident as per their reporting requirements. RBI also provides for outsourcing guidelines for outsourcing the IT functions. So if NBFC is outsourcing IT functions, it should adhere to the RBI guidelines on outsourcing. It shall maintain oversight and control over the outsourced activity to ensure the security of data. Next, regarding the IT governance, it must implement effective IT governance mechanism, which includes appointment of CIO, that is Chief Information Officer, or CTO, that is Chief Technology Officer. Next, an NBFC shall implement business continuity and disaster recovery, that is BCDR policy, so as to develop and regularly test business continuity and disaster recovery plans to ensure that IT system can be restored in case of disruption. Next is regarding the secured payment system. So,
But Aditi, if I am not wrong, it is the responsibility of the chief, what's called a technology officer, the CTO, to ensure all these things, and then he has to inform the board in the quarterly meetings that that about the in case of any policy review is required. Similarly, any kind of cyber attacks have taken place during the year. He has to give an information that no cyber attack has taken place during the last quarter.
yes, yes.
So like
Yes,
that,
yes.
similarly, as I was mentioning, outsourcing guidelines are there. These guidelines are to be complied with whenever any NBFC company is outsourcing, even within the group also.
Yes.
Correct.
Okay. Similarly,
Yes.
there is a IT governance mechanism is to be established, and that is to be briefed to the board, and IT governance mechanism is to be approved by the board before they implement that.
Yes.
Yeah, there is a separate IT strategy committee also envisaged under the IT framework.
You are right. You are
It has
right.
to meet once in half year, and they also report to the board.
And in that majority of the directors should be the independent directors.
Yeah.
Next, NBFC shall have a secure payment system, that is secure online payment system with security measures, including multi-factor authentication for customers. So we are done with the presentation regarding the prudential and governance norms for NBFCs.
In fact, Sean, after going through this NBFC masterclass, I'm really feeling that, if you are the company secretary of a listed NBFC company, so
You'll
that
have
time
an
what will
exciting
happen?
time. You will have an
What?
exciting time.
Exciting times. And similarly, in ice creams, there are one triple sundae ice cream is there. Okay. That is to be a big cone, and then it's to go. So one side you have Companies Act, second side you have SEBI listing regulations, apart from other security laws, and third side you are having this what's called the NBFC list, regulations. So as a company secretary, really your ability is to test if you are handling a NBFC listed company. So you will have a triple sundae ice cream.
Exactly. See, the most other important aspect is that if you are a company secretary in an NBFC, that too in a listed entity, any, whatever you draft in terms of the agenda, in terms of the minutes, unless you know the regulatory framework, you will not be able to, do it proper. You will not be able to draft it properly. And even in the deliberations which might happen in the meeting, unless you understand, at least have a working knowledge of the regulatory framework, you will not be able to understand what deliberations taking place and then minute it accordingly. So it is very, very important for us CS to have at least a working knowledge of all the RBI regulatory framework applicable to NBFCs, and so that he can play his role effectively.
Very right.
And that's why, many of the NBFC companies, especially the systemically important NBFC companies, what they do is they always have a retired RBI person as a consultant or somebody like that, to guide them properly on these issues.
Correct.
There's one more question has come. Pursuant to the FPC norms, it is stated that the communication should be in the vernacular language or language understood by the borrower. If the borrower in a particular region does not know the regional language, then is it expected to the communication in all the languages?
If a customer specifically requests for in a specific language, the company has to give it actually.
I see.
Because for a customer who's in a specific region who doesn't understand the English language, you cannot give him the loan documents in English language. So you will have to.
But Sean, at the same point of time, the customer is not having a right to ask in any language. It may be either in English, Hindi, or vernacular language. Vernacular language means that local language.
See, basis the request of the customer, the companies will adhere, because in case it is given in a language which he doesn't understand, then he would he may always raise, the company was transparent, he was not given the proper details. So RBI is
So
more
that means,
aligned with the customer.
for example, in case of your company, suppose if I am coming from, say, from Northeast, and I am asking you to give me the loan agreement in Assamese, are you going to, you are obligated to give it? You mean
Or
to
at
say?
least we will give a gist of what is, most important MIT, most important terms and conditions, translated, into the regional language.
That is
Got
what
it,
the
got
person is asking. The person is actually asking, the person is not able to understand the regional language. That means, as you rightly say, neither English nor the regional language. So third language.
Then we will give it to him in Hindi or whatever is he's understanding.
Okay. Sir, whether section 139 of the Companies Act 2013 is also applicable to NBFC or not?
113 these financial statements.
No, appointment of auditors, I think, if I am not.
Appointment of the auditor.
See, if I am not wrong, appointment of auditors for NBFC company, there is no exemption as such, but there is a specific what's called
Guidelines on appointment of auditors.
guidelines with regard to the appointment of the directors, sorry, auditors are concerned. And if I am not wrong, auditors cannot be appointed for more than 3 years or something like that. Is
3
there?
years, 3 years. For
Yeah, that is right.
middle layer
You're right.
NBFCs and upper layer, it is 3 years rotation.
Yeah.
And you'll have to have joint auditors. But nevertheless, you'll also have to be mindful of the Companies Act provisions in terms of eligibility and all that. So it is.
The only thing is, Sean, only thing is that if Companies Act is asking you to appoint the auditors mandatorily for a period of 5 years at one stage, but if that what's called as your NBFC regulations are asking you something else, then you have to comply with NBFC regulations.
Correct, exactly.
Yeah.
Any regulation of RBI in writing of loans?
To my knowledge, there is no specific in terms of write-off, but there are various provision requirements which are applicable.
As per the RBI guideline, auditor can be appointed only for the 3 years, only as a company side. Just now only you discussed that. Actually.
Yeah, he clarified. Sudhakar clarified.
Yeah. There's a few compliances has different timelines of RBI regulation and company side. In such cases, which regulation is to be prioritized first? Whatever the stringent regulation, because I know in the NPC company when we are working, the financial statement has to be submitted, I think, within 30 days of the year end. That is the regulation is there. So we normally used to get the auditing done and the board meeting held and submit the audited financial statements within that period. So whatever the stringent regulation one has to follow.
See, not only stringent regulation, though we normally say that stringent regulations, but a company secretary should know that he has to comply with every regulation applicable to that company. Means what? Suppose, as I was mentioning, that on the Companies Act, you have to anyway comply with. If your company is a listed company, comply with SEBI listing regulations. If your company is an NBFC company, obviously you have to comply with that also. Now, what is stringent regulations means that even if one particular regulation is giving you an exemption, if the other regulation is not giving, you cannot avail that exemption. That is what is called a stringent regulation. So you cannot, say what is the stringency? Because last time somebody asked me about in one of the forums that what do you mean by stringency? There is no stringency defined anywhere. Only thing what you have to do is you have to comply with all the regulations applicable to you. That's it.
Yeah, you're right. Actually, I only meant that timeline because as per the company said, the timeline for the audited financial statement. When it comes to the NPC company, that timeline is not available. Appointment of the CCO requires the diligence, but it needs format of the due diligence has been prescribed. Can we use the format prescribed for directors and promoters and shareholders?
No, the circular on CCO details various requirements. One has to derive the diligence format from there.
Sir, invariably, RBI takes its own time even to register the return file or grant approval, even in the change of the status of a NPSC from closely held public company to private company.
So, is there a question there?
But your question is not.
I don't know. He's saying
it's
like
a
that.
dissatisfaction.
Okay, he's expressing the dissatisfaction. Okay. Policy and appointment of a statutory auditor applicable to NPSC.
See, just 1 minute, Bala, 1 minute. See, with all due regards to the regulators, one thing I must say that several times it happened. In fact, when I was speaking to the MCA officials as well as AV officials also, what they say is when you are moving the application for approval, that time these applications are not prepared properly. So what happens is that regulator has to revert back to you, asking for more information. So it is the responsibility of the company secretaries also, while moving the application, it should be in such a way, it should be comprehensive, and whatever the supportive documents are there, they have to be there. It should be in a self-explanatory mode, because regulator is not getting, see, very rarely it happens that they are not getting back to you. So we have to see from our side also, are we, did our homework properly and thoroughly or not? Once you did that, then you need to what's called have a liaison with the RBI. That means you have to pursue, pursue the matter with them, that whether any further information is required or something like that. Yes, sometimes it may so happen also by that there might be some kind of a what's called as a delay from the regulator side. But as far as RBI is concerned, my dealings with RBI are always very cordial. Number one. Number two, I find it is one of the efficient regulators also.
I completely agree with whatever Sudhakar has said.
My experience with RBI also good when I worked about 3.5 years with the NBFC company, because we never had this sort of time and other things and all those things. I think RBI was actually quick enough, really, according to me, in a timely manner. I also have a feeling that they are there. As you
They are very approachable, by the way, actually.
Yeah, that is right.
Only NBFC registration itself is a bit.
That they already have a universe of NBFCs, which they find it difficult to monitor. So that may be the reason.
Yeah, I know. They are telling since years this. Yeah.
RBI requires time and again filing the yearly returns, such as annual financial statement, twice or thrice. Onus is actually puts only NBFC to file it again. I don't know. The experience is something different. Can the statutory auditor, after the tenure as the appointed statutory auditor, be appointed as the internal auditor of the NBFC?
No, there is some cool-off period specified in that statutory auditor guidelines. If I'm not wrong, it is 2 years, I think.
Appointing the independent director for NBFC Private Limited is not mandatory. RBI mandated for ID appointment. Such cases is difficult to follow the Companies Act because technically e-forms are not made in such a way for a private limited company. How to convince the RBI officials during inspection of such matters?
So when you file the e-form, you can attach a clarificatory letter, saying that you are appointed independent director because of the RBI regulations, and that will form part of the form anyway at the time of filing, that we can show to the RBI.
That's all the questions I have, I think so.
Yeah, there was one question, I think, which missed out.
Yeah.
Policy and appointment of statutory auditors is applicable to NBFCs having total asset size of 1,000 crores or also below 1,000 crores. The statutory guidelines or guidelines on appointment of auditors is applicable to all NBFCs other than, the one which has the asset size of less than 1,000 crores. Less than 1,000 crores NBFCs have an option to follow the guidelines. So once you have decided to follow the guideline, then you will have to have a policy.
I think all questions answered.
Yeah.
We can close now.
I think one more message has come. Let me see that.
Somebody is asking for the PPT.
That too. We are sharing, it will be on YouTube channel.
Yeah, recorded version is actually there in the YouTube channel. You can actually access to it, which contains the PPT as such. Yeah.
Yeah. So all webinars will be there. Okay. I think we can close.
I think we can close, Dipti.
Yeah. Atul, you want to say something?
Sorry, I was away, for some immediate, the thing. I've just joined.
Okay.
But it was, I believe it was wonderful presentations. And thank you, sir, being part of us.
Good afternoon, Atulji.
Good afternoon. Sorry, sir, I missed your thing. But anyway, now because of the technology, we can always review, afterward also.
Yeah. Okay, thanks all. We thank all our panelists for today's webinar, for joining us on our knowledge sharing journey on behalf of entire team of Mehta and Mehta. Thanks all the participants.
Yeah. Thank you all. Thank you all.
Thanks.
Thank you all.
By the way, this week we had more number of participants compared to last week.
Yeah. So all these videos are available on the YouTube. So if you can subscribe to this YouTube channel, you will regularly get this alerts also. So yeah, you're always welcome. Thank you.
Thanks,
And you
Arif.
can also
Thank
suggest
you.
some new topics in case if anybody wants to suggest some good topic also. We can always take this in our webinar.
Of course,
Thank you. Thank you.
next week onwards, we are starting Alodia master classes. Thank you.
Yes.
Thanks a lot to everybody.
Thank
Have a
you.
good
Thank you,
weekend.
sir.
Thank you, Mr. Bala. Thank you, Sudhakar ji.
Thank
And
you,
thank
sir.
you all.
Thank you.
Yeah.
Thank you, Ms. Deepti ji. See you. Bye.
Bye.
Bye, Sudhakar.
Bye.
Bye,
Bye,
sir.
sir. Bye, everyone.